Welcome. You're listening to John Hyman from Commercial Real Estate Online. We like to do short videos to help commercial real estate agents and brokers with their sales, leasing and property management activity. This particular matrix that you are seeing on the screen now relates to property management training and tips and ideas. I have used this previously, and today in this brief video I'll select another topic for you to review and understand. In saying that, and before we go there, if you like a lot more tips, particularly regards leasing, sales or property management, you can go to our website at commercial-realestate-training.com. A lot of free information there that can help you with your challenges in the industry, be it in prospecting, doing the job, getting the right clients that you need, or perhaps growing market share, or even commissions. So let's go back to property management. Certainly the job of property management is quite unique and different when it comes to working with clients and indeed winning the business. It's not the same as sales and leasing. In property management, it's quite a knowledge-based part of the industry, which of course is supported by specialized skills, and the triggers to win the clients in this segment of the market are quite different. Anyway, let's pick up on one of these topics. I have talked to some of these other topics in other videos, but in this particular one I'll go further into the asset planning process. Now, in property management being office, industrial or retail property, you will have the need with those moderate to larger properties to do some asset planning. Now, within asset planning there's many different things to think about, so let's have a look at some of them. I'll put some topics here relating to the key issues. Perhaps you can add to this list. However, let's pick the key ones that I've got here. From asset planning, I would suggest that you require and should do a formal document at least once every 12 months and review the document quarterly as it relates to the property, the market, the precinct and also the landlord's plans and intentions. Now, the asset planning process, when you look at the individual segments, there will be a need to consider the anchor tenants that are in the property currently. Those anchor tenants are usually there for many years, perhaps 10 years, 20 years. The leases for anchor tenants are quite long, typically, and the options for renewal are also quite long, and perhaps even multiple options. So you could have options of 3 times 10 years or 3 times 20 years. So the anchor tenants are well chosen for the asset, the location and the property. They bring a lot of strength to the asset, and of course from that they then encourage customers to visit the property, which then can have a flow through to specialty tenants within the asset. So the anchor tenants that are chosen are very special and unique. They will bring the customers to the asset. Essentially in a retail property, that's very important. So when you look at an anchor tenant, you have a long lease term typically. You will have multiple options, usually frequencies of 10 or 20 years, perhaps 25 years. So the anchor tenant has to be right for the property for the long term. That being said, the anchor tenant from the lease should have a property involvement. In other words, you want them to get involved in the future of the property and the success of the overall tenants. An anchor tenant will bring a lot of success to the specialty tenants within the property. So if you are a property manager managing a complex, a large property, get involved with the anchor tenants, encourage them to get involved with the specialty tenants. And indeed, over time, you can build a lot of profile and market presence for the particular property, and that will in turn have flow through to the market rental that you recover. So let's go back to another stage here, and this time we'll have a look at capital expenditure within the asset planning model. Capital expenditure involves major items of replacement within the property. Notice I say replacement and not repairs and maintenance. Capital expenditure might relate to a large air conditioning system or a major plant replacement to keep the building running. It might be a cooling tower, for example. Capital expenditure is handled differently from an expenditure point of view, and certainly capital expenditure, whilst it is a deduction from a taxation perspective for the landlord, capital expenditure is not loaded into the building outgoings from a recovery point of view against the tenants. So capital expenditure needs to be budgeted. Some of the capital expenditure in a building is discretionary. In other words, maybe you can stretch something out over a period of a year or 2 years. So perhaps the replacement doesn't have to occur this year, it could occur next. However, some items of capital expenditure are certainly essential, and that might be the air conditioning plant or the cooling tower or the chiller or the compressor. When it's essential, you've really got to work out how you're going to replace that item with minimum inconvenience to the tenants in the property. And of course, the capital expenditure item will usually be a big chunk of money. That being said, if it's a large amount of money, then that will need to be budgeted for from the net proceeds from the building on a monthly basis. Perhaps special funds need to be set aside each month for a number of months to have sufficient funds to look after that capital expenditure item. So some are discretionary, some are essential, and then you'll have the timing of the works. And with some capital expenditure replacement items, the works can be disruptive to the building and also the tenants and the customers. So that needs to be planned and considered. So let's go back to the asset planning model again, and let's have a look at some expenditure issues. So ordinary expenditure relates to repairs and maintenance. Most ordinary expenditure will be active within the recoverable items under the terms of the lease for the tenants in the property. That being said, you will have different leases. You'll have net leases and gross leases. But expenditure in a repairs and maintenance sense will certainly be in a category that can be recoverable, subject to the types of rental that are charged within the property by the landlord for the tenants. So when you look at expenditure, you should have a budget. The budget should be timed throughout the year, and certain items of expenditure will be perhaps monthly, perhaps quarterly, but you'll need to budget that expenditure group of key items so that the timing is correct from the cash flow for the building. So that if you have rates and taxes, for example, the rates and taxes bills or accounts might only come in 2 or 3 times a year. So that expenditure budget needs to reflect the timing of that major expenditure. So let's look a bit further, and within expenditure you have some items that are controllable and some that are uncontrollable. Now, the controllable items are those that you have some discretion on the timing and the replacement. In other words, acting on those particular issues. Certainly you can put them off for a little while perhaps, and you can also budget them as far as when they will be done. On the other hand, uncontrollable expenditure is a little bit different. That relates to the rates and taxes where things just have to be paid. They cannot be put aside, they cannot be put off. So uncontrollable expenditure items go to a certain time within the budget and they have to be dealt with. In other words, the budget will say that money has to be held aside for these particular items. The budget, however, is more flexible when it comes to these controllable items. Certainly the budget, when it comes to controllable expenditure, can have some flexibility. So again, within expenditure, you'll have major items, you'll have minor items, perhaps even you'll have some matters relating to contracts, perhaps contracts for air conditioning, security, fire services, lift security, escalators. Major items like that need to be budgeted and timed within the budget. So let's go back here a little bit further and look at income. Now there are different types of rental income. I put some here for you just to give you an idea of how it works. So if you are managing a property from an asset planning point of view, you do need to understand income and how it works within the property. The landlord will want a good net income, a net rent. That being said, the net rent is actually impacted by the outgoings for the property. So you do need to understand the outgoings that are payable, in other words, the expenditure for the property that will be offset through the terms of the lease against the rentals. So income means net rent. From the net rent perspective, of course, the landlord will be recovering the outgoings from the tenants in some way or form, and the lease will support that. However, you will also get gross rents within a property, and in the case of gross rents, you'll find that the landlord will be standing the cost of the outgoings for the particular tenancy. However, the rental for the tenancy will be loaded for that extra premium that the landlord has to tolerate as part of having the tenant in the property. So when you look at doing a rent review on a gross rent, of course it's a rent review based on the existing gross rent, and you are escalating a component of outgoings within that number to the next rental level as part of the rent review process, e.g. if you were doing something on a 4% or a 5% rent review process. In a net rent situation, the rent reviews are actually calculated on a percentage of the net rent. The outgoings are left outside of the equation. Just another couple of numbers here for you. We have a passing rent. The term passing rent means the rent that is actually paid at the time. So if you're looking at a lease or a group of tenants within a property, you want to know what the passing rent actually is. And from that, another group of words here, effective rent. Now, an effective rent is the rent that is payable without the impact of any incentives. So if there are no incentives for a particular tenant, then the rent they pay is an effective rent. If, however, they do have some incentives as part of their occupancy deal, then the rent they pay will be a face rent, because the effective rent will have been inflated by the cost of the incentives to get to the face rent value. So that's how it works. Let's have a look at some incentives. These are some of the incentives that are typically active in any property activity today. You will get some discounted rents. You'll get some fit out activity that could be paid for by the landlord. Perhaps there'll be a contribution of cash towards the fit out, and sometimes the landlord will give some rent freeze. So the the incentives change quite frequently from area to area and property to property. As a property manager, as a leasing expert, you do need to understand exactly what types of incentives are sitting in the market today and what the value of them would be relative to the property type. So that's incentives. Let's just go back another stage here and we'll go up to asset planning again. And within asset planning and the rental structures, I did just cover income for you, and I went through the various types of rental there. Let's now go back to leases, and I'll finish on this point. Within leases, you'll have lease standards, you'll have rental types, guarantees and bonds, and also documentation strategies. This says that the asset plan should reflect particular choices and logic decisions made when it comes to how the leases will be structured for tenants within the property. So the landlord will tell you, as the property manager, exactly what they want for the property as far as lease occupation. From that, you can structure some lease standards. That might be rental types, it might be lease duration terms, rent reviews, also any option periods. From that also, you can look at the rental types, which are gross, net, face and effective, and make some choices in that regard, and you will have the incentives that can also apply there. Over here you'll have guarantees and bonds. Now, certainly a new tenant entering a property should provide some form of guarantee and or bond. So as a property manager or leasing expert for a property, you should understand what the typical guarantees and bonds are for a property of that type in that location today. Typically and on average, most guarantees are in the form of a bank guarantee, and those guarantees will usually be to an equivalent amount of rent plus outgoings plus any government taxes to at least 3 months worth of rental, perhaps even 6 months worth of rental. And when you get that sum of money on a bank guarantee, that is then retained by the landlord to draw on if the tenant defaults for any particular reason. So they are the aspects that relate to leases, lease standards, rental types, guarantees and bonds, and documentation strategies. So let's go back to where we started here. I won't go through these other issues at the moment. However, I have covered these as part of the asset planning process. So in this brief video, I have given you a few ideas as to how to consider the issues within asset planning. These other issues I'll cover in a different video shortly. Thanks for listening today. This is John Hyman from Commercial Real Estate Online. As I said earlier, you can get lots of free tips and ideas from our website, which is at commercial-realestate-training.com. There's the website address for you. Thanks for listening today, and I hope to catch you again sometime on the internet.